elevation.
Cool and Dre.
Big blunts, dope boys wanna smoke with me. Now we ride double M's through the whole city. Niggas talking down, but they always feel me. A 9-figure nigga, all I wanna talk is business. I seen a big mouth get a closed casket. Self-made, took over the whole racket. A kilo after kilo, see who moved the most. 200 for
What's going on, guys? Welcome back to Goofy Investing, where we talk about investing in the stock market. This is the Growth Investors channel, all right, where we specialize in growth stocks, mainly in the mid and small caps. Today we're going to do a ticker analysis, okay? We're going to look at the business of Geni Sports Limited. Ticker GENI, trades on the New York Stock Exchange for $4.24. Market cap is 1.13 billion. Okay, little price action decline over the year, 57.60%. This stock is down. We're going to take a look at some of the fundamentals, business model, valuation, what's going on with the company, and of course, I'll give my little 2 cents in on whether this is a good investment or not. All right. Quick disclosure. I do not own stock in the company. All right, as you can see on the screen, I don't hold a position. You could pause this so you could see every position I got. This blanked out position here, I assure you, this is not the Genius stock. That is a Patreon hot stock. All right, so take it for what it is. You're getting an unbiased opinion on the actual company. So what are they? What do they do? Okay, where are they headquartered? All right, so this is a UK company. They're headquartered in London, 27 Soho Square. All right, and you know their industry is casinos and gaming and consumer discretionary sector, which is pretty accurate. I think that casinos and gaming is a discretionary item to where people need disposable income to partake. All right. So, essentially, let's talk about what it is they do, all right? That's the sector and industry, but what is it they actually do? Are they an actual casino or what have you? Well, they're part of online casinos. They provide the infrastructure of, the actual the software platform involved. They do a lot of gaming data analytics, market making, and so forth. So if you log on to one of these casinos here, uh, Bet MGM, Betway, here's some of their partners that they partner with. They have the infrastructure. You see the FanDuel there. Well, these casino DraftKings as well. These actual online casinos use their software and benefit off data analytics for betting patterns and so forth and market making. And, they're the ones who provide that for them, okay? So, recently, this company did an acquisition. Typically, I go to the sniff check on their valuation and check their cash and so forth. But, little exception, they got an acquisition that closed recently for Legend, all right? Digital media network Legend. And they closed this acquisition at $1.2 billion early in May. 900 million in 900 million, 800 million in cash, and 100 million in stock, and an actual 300 mil earnout. Okay, granted, some key performance metrics are met. We'll go to the actual company's valuation sniff check, and we'll take a look at that. Currently, they have 197 mil in cash, 30.55 mil in debt. But with the closing of this acquisition, which will reflect on the next quarterly statement here, they're going to be looking at 800 million here on the debt column and a 10% dilution on the actual stock. Or a little under 10% dilution because 1.13 billion market cap is what it's trading at. All right. So glad that we got that out of the way. We'll talk more about the debt. and through the earnings call and so forth. Consensus estimates got this company growing 49% by the end of 50% for all extensive purposes, 49.99%. Suspiciously looks like 50%. I can see that. All right. They got good growth rates so far, but um, going on to the next up until 2029, they're set to CAGR above 20% annually. So there that is. That's something to consider. Okay. Profitability margins, gross profit is a little bit small. With the acquisition, this acquisition is going to be accretive to expansion of EBITDA margins and leverage free cash flow margin. So the company says, okay, we have to actually see what the company actually does. I'm tracking that Legend has sales of maybe around 250 million to 300 million. With over a billion buyout, you're looking at a 4 to 5 times sales multiple premium on the company they acquired. When this particular company is trading at a 1.55 trailing sales, 1.5 times trailing sales. So they're doing trailing to date 713.5 million in sales. Okay. So let's talk about the actual earnings call, and what the some of the terms of the debt, okay? So 825 million term loan A at SOFR plus 350 basis points. That's a fancy way of saying 3.5% interest. Plus SOFR, which is a floating variable rate of interest decided by the UK international banker, what have you. So some UK bankers brokered the deal and made this possible. Um, they do hint that they they actually intend to use free cash flows to deleverage, to discipline deleveraging. That's a fancy way of saying we're going to pay off principal with our strong free cash flows, okay? So let's look at Genius's free cash flows since they're talking about free cash flows. Currently, they're doing 100 million in levered free cash flow, okay? So if they have 100 million, and keep in mind this Legend acquisition, which is I'm tracking as a private company, they were doing 250 million to 300 million. I believe that a portion of this acquisition covers the actual debt of Legend. So the debt holders of Legend will be paid off via this acquisition, and the new terms of another debt will take over all of that, and then that'll just be that. Okay, so there's that to consider. What is Genius going to benefit off this acquisition, according to management? Well, Legend is more of the digital and media properties. Genius plans on adopting this merger, acquisition, whatever you want to call it, to expand their offering for digital media and data analytics to not only see the trend of what's hot right now on the market, but the trend of where they project the actual betting and gaming activity to go towards. Okay, um, so that that should complement their full tech stack on their whole SaaS product. Time will tell. Okay, I like the slide deck. Pretty simple here. 15 slides, nothing crazy, straight to the point. They tell you a little bit about what they do. With their actual betting platform, it's interesting. They have these, you know, that within the actual sports, there's some sort of data entertainment value that these sports bettors like to consume or see while their bets are being made. And so I mean, there may be little pop-ups on their media within the platform that spit out some specific stats of some specific players, which is pretty cool. Um, they're infusing AI, agentic AI, and artificial intelligence to expand margins and efficiency towards their tech stack. I'd expect nothing less. So, and I'd expect that that's probably needed with this low gross margin. So, the guidance is that, upon the closing of this acquisition, EBITDA and leverage free cash flow, or cash flow, I should say, will expand. So, the mention of net income, is not a little bit premature. They're saying that this acquisition will speed up their timeline to positive EBITDA within shortening it 2 years out. Okay. So there's that to consider. Let me see here. I will get rid of this. Let's talk about the earnings call. All right. Um, Earnings call is, ISS management is pretty competent. They know about their tech platform. They know how to complement it. They know the vision that they're trying to instill with this company. Um, how do I think about the merger and acquisition and what they intend to do? Well, I think this is an overzealous acquisition, I'm afraid. Um, this acquisition, they're paid more than what their own company is worth, and they over levered, they polarized and levered their own balance sheet. So, I mean, to a lot of people out there, that don't understand. So, what do I think about that? Well, let's go to ratings and see what the street says. Street says they think that the stock's going to be $10 by the end of a year out on the average side, and $19 on the high side. Stock's $4.24 right now. With the actual acquisition and the terms of how much they use debt, all right, with the free cash flow profile, margins, and growth provided, with them paying 5 times sales, it's going to take several years for them to pay off this debt, and it's going to take several years for them to perhaps see accretive performance to result in shareholder value. 100 million in free cash flow on a conservative basis. If we say that, if we assume that 100 million per year is what they're going to do, and they're going to dedicate that towards debt reduction and interest pay down and so forth, I think it's going to take 15 years for them to pay off this debt. And with the actual cash burn, with their actual cash burn profile, they're going to have to raise a bunch of capital. So my idea is, if they were going to do a merger and acquisition, they might as well just merged it via all shares. Okay. That's my perspective. That's how I would have done it. Should there have been a little bit of a cash incentive buyout? Sure, maybe not 800 million, okay? Maybe they say, you know what? We'll split the difference on the downside. We'll give you 20% cash and the rest in equity. I would have been more appeased for that. Because, do the people selling on their buyout believe in the vision too? Right? And are they betting that they want to participate as well? So that's kind of what I would have liked to see. And if we look at insider ownership for GENI, sure, there is a little bit of insider ownership of 8.76%. Most of the float, a lot of the float is owned by institutional shareholders, 82.74%. So I'm not really a fan when institutional ownership is high and they're doing a lot of debt stuff. All right. That's not really a good recipe if you ask me. Now, if the insider ownership was 25% and then they did this acquisition, maybe there's something there, okay? I'm very bearish on acquisitions, especially, within these different spaces that are in consumer discretionaries, where they're paying a huge premium price to sales multiple above their own company, and they're paying a valuation that's over their own company's valuation on the market. So there's that to be considered. All right. So I do have a bread insert. I have a real long thesis on the Roman bread and circus business model being applied to the United States, at least, and different countries around the world. And essentially, the delta and the gap between your wealthier, affluent people and your poor people will begin to widen, okay, as wages do not catch up. And I'll admit this thesis is very long, probably beyond my lifetime, but we probably may start seeing it pan out decades from now when I'm an older, more mature investor peeling off dividends. But this is how I see this. Okay, I see that there's value in that tailwind of that actual bread and circus business model thesis, and I think that these guys, and what they're setting up with that business model will be accretive and will play a role with the high free cash flow margin setup. In the future is going to be a cash flowing machine, but that's gonna take a long time for that to happen, you see. All right, they got to get net income profitable. They have to make their whole platform accretive to that, to set up for those free cash flows. And after this acquisition, now you're going to have to worry about a debt maturity wall. You're going to have to worry about, the different servicings of the debt and the overlevered balance sheet and their cash burn with them not being positive, okay? Being an actual company that makes money, all right? So there's that to consider, all right? I like the way they did this earnings call. They answered all the questions. They were a little hesitant on mentioning the NFL, and the visibility with Legend and so forth. And NFL is a little bit recluse when it comes to their media licensing and so forth, but they've loosened up a little bit, but they're still tight when it comes to that. NFL is one of those organizations, they really do not like to license their stuff out. They like to have exclusivity towards that brand, all right? So it is what it is. Things will come, all right? Um, Leadership, all right? Management and leadership. I think they're okay. I think they have a lot of experience in this, and a lot of intelligence. They say it's genius sports. We're going to see how genius this acquisition is and their execution on how they're gonna play this out and their product offering. Okay, are they going to be able to make this acquisition accretive to shareholder value in the long run? Their intent is, and their vision is, no doubt about it. But it's just going to come down to execution. I'll tell you what, Brian Castellani, the CFO, this guy, we're going to see how good this guy is. All right. If you're a shareholder in this company, I don't intend to follow up with this company, but if there's enough interest in it, I will. But it's going to be up to the CFO to manage the financials of this company in the right direction. There's no more higher stakes than this player right here, which is the CFO. Sure, the founder and CEO and this guy, the chief product and technology officer, and embedding this acquisition to the final product is important and all, but we got a lot. This company's going to have a lot of debt on the balance sheet, and this CFO has got his work cut out for him. All right. um what do I think about this as an investment? All right, I think, is the stock undervalued? Is it a good investment in the short run, the long run, and so forth? Okay. Well, first of all, I don't believe these Wall Street targets are going to hit. All right, I got the stock going down. I got it going down to $3 in the short run. Probably next quarter, we'll see. I hope I'm wrong, but it is what it is. I'm not perfect, but once the market realizes their overlevered balance sheet and cash burn and the high expensive acquisition and the actual expectations of different reductions intellectual property and value and so forth off their balance sheet of goodwill. You know, I got the stock going to $3. All right. April 10th, there was a little wink here to $3.92. I got to go into the low threes. How much, if I was very interested in this company, I believed in the vision, I believed in the management team, and I see what they're trying to do, and I think they'll be successful. What do I think about that, and what price do I need to pay, me personally speaking? All right. I need to get this down around $2.50, guys. All right. With the over-levered balance sheet and everything that they have to do, with the time, considering that it's going to take probably a decade or longer to make this all accretive, to get over that big price of that acquisition. I need this at around $2.50. Very possible this goes down to $2.50. Would I buy it if it was $1 a share? No, because I don't believe in it. All right. Now, long-term investment proposition. All right. I can see this more as a legacy growth play, to where this company is a big deal several decades from now if they survive through all the cash burn and everything, and their business model starts taking over the market share of global betting and gaming, and they can be the big player in the game. Sure, I can see that happening in a bread and circus business model. And you want to make sure that your seed is secured, where your seed will inherit these shares and be getting paid out dividends, and they'll be okay. I can see this as one of those plays. But I just can't. Sure, they're going to put up good growth numbers, but a lot of the time there will be a cloud narrative to where their levered balance sheet will hit them, and their cash burn will hit them in the long run. All right. So I'm not saying it's a bad investment, but it's a bad short-term investment, if you ask me. It's my humble opinion. All right. It's not for me. If they had now I tell you what, if the gross margin was around 70% and the acquisition was formed differently, maybe the setup may be different. But as it stands right here with these low gross margins and the acquisitional costs, I'm kind of staying clear of it. But that's what I got. If you're getting value, like and subscribe. Check out my Patreon. Join the like-minded investor crew, where we just win, and win, guys. All right. $15 a month. You really can't beat the value. Get access to exclusive content, more direct access to me. If it's too much, click this button up here, pay annually, and save 20%. I hope you guys got value out of this. I thank everybody for their support. And with that being said, I love y'all, and take it easy.
You take the blue pill, the story ends. You wake up in your bed and believe whatever you want to believe. You take the red pill, you stay in Wonderland, and I show you how deep the rabbit hole goes.
One thing to question your mind, it's another to question your eyes and ears.
Remember how you felt when you were alone? There's nothing. You were miserable. That's why we're here.
You're not gonna do it, are you? Change the world. You're afraid.